In this session, I'm going to discuss about the financial reporting standards, wherein I would primarily be looking at the key objectives of financial reporting. Is financial reporting really required? And if it is required, what are the various things that any financial reporting need to address? Then, who sets these standards? Who sets these standards for financial reporting, and who enforces them or implements those standards? Who has the responsibility of setting the standards of reporting? Who has the responsibility of implementing the reporting standards? Who are the regulatory authorities who typically implement these financial standards? We'll try to look at them. And is there any kind of convergence across the world in terms of the usage of the standards, or each nation is having its own reporting standards? What is the kind of integration that is occurring across the various reporting standards globally? So, giving a rise to the IFRS framework, International Financial Reporting Standard Framework, let's try to understand some basic aspects of that particular framework, some characteristics of it, key characteristics of that framework on a broader level. Let's try to understand the IFRS framework. If at all there are some kind of constraints on that, as per that framework is concerned, trying to understand what are the various elements that need to be reported as per the framework, and any other kinds of requirements that are there specific to this IFRS framework. Let's try to understand them. And what is the kind of convergence that is apparent globally towards this IFRS framework? What is the kind of acceptability associated with this IFRS framework? All these various aspects we will try to understand. Then we would try to spend some time in terms of understanding what do we mean by effective reporting. What constitutes, what are the key characteristics of effective reporting, and what are the key barriers that impact the effective reporting? Then some kind of comparison on a broader level let's try to do between IFRS and the other frameworks, especially the US GAAP or any other reporting frameworks that are existing across the world. We'll try to see what are the kind of key differences that are existing, and finally we would try to focus on whatever are the reporting standards that are evolving, the new developments that are coming in the reporting standards, especially with respect to the new products, or especially with respect to the new transaction types that are introduced. With respect to all these things, how are these handled typically on a day on day basis? All these are various aspects that we are going to look at in this particular session. So we'll start off with a basic understanding of the overview of the financial reporting standards. So the key objectives. So we'll start off with the key objective of the financial reporting standard, right? So as we already know, the key objective of financial reporting, any financial reporting, whether it is IFRS or GAAP or whatever, the key objective of financial reporting is to provide some kind of information to the investors, creditors, and various other stakeholders regarding the performance of a particular firm. That's a key thing that is being provided as a part of the financial reporting. So it gives a good picture about the past performance of the firm. It gives the current performance of the firm, and it also provides something to do with the futuristic outlook through the various reports that come out through the various MD&A and various other documents that come as a part of the annual report. Now, the main intention is this financial reporting. Can it be done by the firms in their own manner, or should there be some set of standards for providing the financial reporting? See, the financial transactions are pretty much complex. There are wide varieties of transactions. So the whole financial transaction space is very complex. The kind of estimates that may have to be used could be completely complex. The assumptions which may have to be made can vary from organization to organization. So, if standards are not there addressing all these things, we could see that the firms can start reporting in their own manner, which would be completely inconsistent with each other. Right? There is a lot of inconsistency in case the standards are not reported in a standard manner. So, the intention of the financial reporting standards is to come out with a few set of alternatives. Instead of a large gamut of anything can be reported, few set of alternatives or few set of possibilities in which the financial statements can be reported. So someone has to develop the standards in such a way that almost every transaction can be reported more and more consistently by different companies in different industries, and it has to have similar meaning in all the contexts. Any financial transaction with the standard of the presentation, it should carry the similar kind of a meaning in different organizations in different contexts. So, so while on one side providing that kind of policing or standardizing, on the other side there should be some amount of a flexibility also built into them, so that some numbers can be left to the discretion of the management purely based on the kind of business they do. So the intention of development of the standard should be in such a way that they should try to address almost all the transactions, bring about consistency in the various financial transaction reporting across the periods, and along with that provide some kind of a flexibility so that the management can operate with its own estimates and assumptions which are more and more specific to their business. And on the other side, a good financial reporting framework should even help the analysts to evaluate the financial statements of the companies more and more consistently, and probably get into the valuation of the firms in a much more effective and consistent manner. So these are some of the important objectives that come out of financial reporting. And coming to who would set these standards, now we came to know that standards are very much required because of the complexity that is there. So generally we find the standards are set by some kind of private organizations who have lots and lots of expertise with respect to the various financial transactions, containing a pool of accountants and auditors who will typically get into the setting of the various financial standards. And on the other side, there are government organizations which are regulatory bodies, which have the primary responsibility to validate these various accounting standards and take the legal responsibility of the implementation of the financial standards. It is to ensure that these have the responsibility to ensure that every organization implements these various standards and prepares the financial statement in adhesion with these financial standards only. So coming to the standard setting bodies, we see Financial Accounting Standards Board, which is setting the US generally accepted accounting principles standard. Then we have International Accounting Standards Board, which is primarily developing the standard called International Financial Reporting Standard. So this is more focused towards a global standard, trying to bring about some kind of convergence across the various accounting standards across the world. Similarly, like this, we find so many different accounting standards across the world. Different organizations setting up different standards with respect to different financial transactions. And now, because of the global operations, there is a need for some kind of convergence across these various standards. So, from any perspective, when we look at the standard setting, all these standards need to be highly professional, right? Any kind of standard setting body, we need to see that it is highly professional, not carried away by special interests of some specific parties, right? That's a kind of professionalism that has to be maintained. Then all the body has a good amount of authority, resources, and skills and competencies to develop, to understand the various financial transactions and try to come out with an effective framework. And the process should be very much clear, explainable, consistent across the years, across the various kinds of organizations. The framework should be clearly in place. If at all some standards need to be added or subtracted or deleted, a proper framework needs to be there in place, and the whole body should be able to work more and more independently. More and more independently, though some kinds of inputs are taken from the various stakeholders, the body should be working more and more independent, and any decision that this body is making with respect to the standard, this decision should be more or less in the interest of the public. So all these are some of the important necessities, especially with respect to setting of the reporting standards. Whereas on the other side, we look out for the regulatory bodies, which are more and more government promoted. We see a Securities Exchange Commission in US, Financial Services Authority in UK, and SEBI in India. There are various regulatory bodies which are primarily responsible for for making sure that these standards are being adhered to by the various organizations in terms of their reporting processes. So they do ask the various organizations to file in the various reports, various documents at regular intervals. We have seen that there are various forms and documents that need to be filled by the organizations at different points in time. They have to file annual reports, they have to file quarterly report, any kind of proxy statements that have been issued to the shareholders, they have to be filed. any kind of significant changes in the accounting activity, any significant changes in the accounting policies or standards, any kind of major asset acquisitions or disposals, they all need to be filed at regular intervals with the regulatory body with the regulatory body. So all these things again on one side they become useful information for the analyst to evaluate with respect to the valuation, and at the same time this brings more and more consistency in the way organizations report their financial performance. Even the directors holdings of the company, number of shares each director and senior managers have in the shares of the company, all these are going as a part of different forms. 10K forms are typically the annual reports, 10Q forms are quarterly, then DEF 14A is more associated with proxies. Then 8K is something more associated with significant material changes and events that are occurring. So all these forms are typically filed by the companies with the SEC as well, and especially if the firm wants to go for a private placement. So instead of taking the shares to the public, it wants to place the shares with a private qualified buyer. It can very well do without registering with SEC, and for that it has to notify the SEC through Form 144. So like this we see that the regulatory bodies have come out with a mechanism wherein the companies are required to file various forms and documents with SEC at regular intervals of time, so that one, a consistency be achieved, two, all the accounting standards are completely adhered to. And primarily the intention of the regulation which we see by any regulatory body of any country, we see that in protecting the interests of the investors. There is a lot of information asymmetry in the process. So making sure that the investors' interests are typically protected. Every action that is being taken should be in the interest of the investors itself. And the second important objective comes out to make sure that the markets are more and more efficient, the transactions are more and more fair, and there is a transparency in all the transactions. So one more important objective, and overall risk of the system to be reduced. Systemic risk, which is the risk that the system entirely can fail because of a chain reaction, reduce those kind of risks. So which means today, because of the globalization of the transactions, it is very much necessary that the regulation also should be more and more globalized, and that is where there is an increased pressure in terms of all the organizations across the world moving towards the acceptance of international financial reporting standards. By now, we already see that in the European Union, almost all the public limited firms are reporting as per the IFRS itself. Even in the US, there is a lot of convergence that has already occurred between US GAAP and IFRS. Earlier, it used to be the case that the companies which are following IFRS, they need to reconcile their financial statements suiting the US GAAP as well. But now that requirement has already gone up. Firms which are reporting based on IFRS, they don't need to reconcile with respect to the GAAP. So we see across the world there is some kind of convergence towards the global financial reporting standards. But however, we see a major barrier. A couple of barriers that typically come out in terms of the global accounting is the disagreement. typically the different standard setters of different countries, different regulatory bodies of different countries, they do not agree on what is the best way to handle a particular transaction, best way to treat a particular transaction. There is some kind of disagreement. So in which heading or in which account, which item of the financial statement should this particular transaction be recorded? So that in few of those areas, there is some kind of disagreement between the standard setting bodies across different countries, regulatory bodies across different countries. So that's one place where convergence is finding difficult to come up, and in some cases there is some amount of political pressure, especially by those companies and those individuals who would be affected heavily by the change in the standard. That is quite obvious. Those who are getting affected by the change in standards, they would try to protest from the implementation of the standard. They would try to come out with undue influence. So those are coming out to be the couple of barriers right now towards the move towards achieving convergence globally in with respect to the various reporting standards, right? Now let's look at the framework which IASB has been following for the creation of IFRS. What is the broad level framework that is being looked at by the IASB? The typical framework contains the qualitative characteristics of the financial statements. It clearly explains what are the characteristics that every financial statement standard should typically contain. It also specifies the reporting elements. What are the broad elements that go as a part of financial reporting? It contains a few constraints, right, as far as the financial statements are concerned, and what are the assumptions under which these particular standards are typically developed. With respect to the preparation of the financial statements, what are the assumptions that the companies may have to go with? All these things are very clearly mentioned as a part of the framework. Now, when I start looking at the qualitative characteristics, any financial statement that is typically prepared, it has to meet these two characteristics. One, it should be relevant, and two, it needs to be faithfully represented. So when I say faithfully represented, it is complete, right? It should address almost all the requirements, and it should be completely unbiased. It should not favor a specific industry or a group of companies, and it should be error free. Whatever is the statement that is being prepared, that statement should be complete, it should be unbiased, and it should be error free. And when I'm talking about the financial statements need to be relevant, they really help in the decision making process. The content, the information, it should really help the user in terms of making an appropriate decision making. So looking at the past performance, the person should be able to do some kind of forecasting, some kind of futuristic assessment. So it should be more relevant to the usage for taking various kind of decisions. So there should be a predictive value, it should be predictable. So there should be a predictive value and there should be a confirmative value. If both of them are there, it's even more better. So that is one of the important characteristics that associate with the relevance and the faithful representation, and to make sure that any financial statements are both relevant as well as faithfully represented. Some of the things that typically come into picture are the financial statements need to be comparable. One company's financial statements need to be compared with the other company's financial statements. So with other companies, it should be quite comfortably comparable, and even across time, it also needs to be comparable, which means there should be a lot of consistency with respect to the preparation of the financial statement. The different elements of the financial statement, the consistency in terms of preparation will bring in both the relevance so that the past can be used for forecasting purposes, some predictions can be done, and there can be a faithful representation as well. Then one more property that it needs to satisfy is it should be verifiable. The financial statements need to be verifiable. If different observers or different evaluators are using similar methods or same method, they should get the same result. So it is more verifiable from that perspective. Even if there are different people who are using same method for evaluating an asset or evaluating one element of the financial statement, they should end up with the same result. Then there is another important characteristic associated with the timeliness. The information that comes out into the financial statement, the information that should come out is at an appropriate time. Means the decision makers should be able to use it much before the information becomes stale. So that's what is about the timeliness. The time at which the information is available should be more and more sufficient enough to make a decision. And one more important characteristic that comes out is understandability. Whatever the financial statements that are coming out, any basic user, the person who knows a basics about finance, accounting, financial statement, he should be able to understand and interpret the terminology and the information that is present in the financial statement. So unnecessary information should not be there, and at the same time useful information cannot be omitted. All these things bundled together will bring out the relevance to the financial statements and the faithful representation to the financial statement. So any standards that are getting developed, they should be targeted towards ensuring that the financial statements prepared will adhere to all these things. Then one more dimension that is addressed in the IASB framework is the elements that needs to be reported. Earlier also we have talked about five major elements of the financial statements. One is the assets, then we have liabilities, then we have owner's equity, then we have these three form a part of the balance sheet. Then we have revenues, which are typically called as income as a part of this framework, and then we have expenses. Even the owner's equity in this framework is typically called only the equity. And just as the definitions we know, resources which are controlled, owned and controlled by the firm, they are getting categorized as assets. And these are owned as a part of the past transactions, and the company is having reasonable assumption, reasonable expectation that they will provide benefit in future. some kind of a benefit, some kind of monetary benefit in some form would be provided by them in future. Those things are typically classified as assets. Whereas again, when I talk about liabilities, we are talking of some kind of past transactions that have occurred, resulted in some kind of obligations which are not yet fulfilled by the company, and in the future there will be some kind of outflow of the resources. So those kind of things are typically treated as liabilities, and whatever is the residual interest of the owners, typically assets minus liabilities will give me the equity portion of it. Then an interesting way of looking at the income and the expenses is increase in benefits, right? Typically those transactions that result in increase in the benefits, which may result in assets going up or liabilities coming down. That particular transactions which will result in increasing in the benefits, which can result either in the assets going up or the liabilities going down, which will result in the equity typically going up. So those items are typically constituted as income, and in case of expenses, the decrease in the benefits, which could result either in assets going down or liabilities going up, resulting in the equity portion typically going down, they are typically treated as expenses. And a few important dimensions that are coming out, especially associated with the recognition of these various elements on the financial statement. One, with respect to income and expenses, we have already discussed earlier. The income should be recognized when earned, and expenses should be recognized only when incurred. That's the fundamental that typically holds true. And with respect to the assets, it says that it should be asset or a liability. It should be recognized in the financial statement if the future economic benefit is probable. There is some chance of occurrence of a future economic benefit, and that particular value can be measured reliably. To a large extent, its value can be measured, and to a large extent, that particular benefit is going to occur. If it is very much sure that that particular benefit cannot occur, or if the value of it cannot be measured properly, then we will not recognize them in the financial statement. That is one of the prime reasons a lot of elements like human capital, for which reliable measurement in terms of value cannot come out, these are not getting entered as a part of financial statements, because some entry will get into the financial statements only if the benefit is to a large extent possible to occur in future, and the value of it to a large extent can be measured reliably. So that's one more dimension the framework talks about, the recognition. Then one more dimension that is being covered as a part of the framework is the way in which the various values are measured and reported. That is what we typically call as the measurement base. So here different kinds of costing mechanisms are there. One, we talk about the historical cost. So where the original cost, the cost at which that particular asset was acquired, purchased, that is what we treat as the historical cost. So some of the assets get noted at the historical cost on the financial statements. Then we have a few of them which are represented at the amortized cost, which is nothing but the historical cost minus depreciation or amortization, which is more reflecting the usage of the particular asset, the proportion of usage of the asset that is getting deducted, and that is what we are typically calling as amortized. In some cases, any kind of impairment to the asset also would be deducted and representing the amortized cost. Then we have another measurement mechanism, which is the current cost mechanism. If at all it has to newly purchase that particular asset today, that particular asset, if it has to procure or purchase today, what is the cost that it would be. So a few of them are entered into the financial statement on a current cost basis. Sometimes a few entries are made in terms of realizable value. So if at all the company is going to sell the asset now, how much it is going to get. If that particular asset is same asset is going to be sold right now, how much the company would be getting for it. That is what we call as a realizable value. So some assets could be measured based on their realizable value. Sometimes we see in some cases some assets are noted at their present value, which is the present value of the future expected cash flows. Right? Sometimes assets or liabilities, whatever it is, they are measured at their present values. And in some cases, we talk about a fair value. Probably when two parties are getting into a negotiation of a transaction for that same asset with a good understanding of the characteristics of that asset, what is the amount that gets exchanged between both of them. So this is a measure of the fair value. So what we are saying is different kinds of measurement bases are being specified by the framework, and the definition of each of these different kinds of costing mechanisms or the measurement mechanisms, and for different kinds of assets and liabilities, these kind of mechanisms have to be used for valuation and representation in the financial statement. As we move along, we'll be seeing much more of these different kinds of measurement bases and how well they can be used for valuations of different kinds of assets. Then the next dimension the framework is talking about is the constraints as a part of the financial statements. One, any specific process that is being created, there is a cost associated with it, there is a benefit associated with it. Any characteristic, whatever the information that needs to be presented in the financial statements, there is a cost associated with the presentation of it, there is a benefit. As long as the benefit associated with the presentation is more than the cost, which means as long as the cost of presenting it is much lesser than the benefit, that can very well be presented in the financial statement. Otherwise, it should not be presented in the financial statement. This is one important constraint. And second, anything that is non-quantifiable, right? The human capital, which can't be measured properly. Anything that is non-quantifiable, especially the reputation, the brand loyalty. So all these things which might be assets to the company, but they can't be measured properly. So all these things are not present in the financial statement. They cannot be captured in the financial statement. That's one more constraint with respect to the information that goes into the financial statement. One, if the cost of presenting it is much higher compared to the benefit that gets out of it, it need not be presented. And if something is completely non-quantifiable, there is no point in presenting it in the financial statements. And while preparing a financial statement, a few assumptions that go inevitably. One, the assumption relating to the going concern. It is very clearly assumed that the company will exist for a reasonably longer amount of time, almost eternally. This is one important assumption. Otherwise, all the valuation mechanisms, the whole balance sheet concepts, the whole accruals concept will have to be reworked upon, and lots of adjustments have to be made. So the basic assumption that goes with is it assumes that the company is going to exist for a reasonably long future time period. Along with that, one more important assumption that comes up is the accrual base. So we don't follow the cash base of accounting. So the revenues or the income and the expenses are recognized, especially at the time they are incurred or occurred, not nothing to do with the cash received or payment. So it's not a cash based kind of accounting, it's completely accrual form of accounting. So these two assumptions are quite comfortably taken while preparing the financial statements. A few constraints, a few assumptions, there should be some kind. These are a lot of these things are typically going as a part of the framework that has been followed by IASB in terms of coming up with IFRS reporting standards, right? Now, with the understanding of all these framework-based elements, let's try to understand what are some of the requirements as of IFRS. So the first thing they talk about are what are the financial statements that needs to be prepared as per IFRS. What is that the International Accounting Standards Board has typically specified with respect to the various financial statements that need to be prepared. One is the statement of financial position, which is otherwise called as the balance sheet. This is something that needs to be prepared. Then statement of comprehensive income, which consists of income statement and other comprehensive income. Then it also talks about the preparation of the cash flow statement, the statement of changes to owner's equity. So apart from these four, it also talks about the preparation of the explanatory notes, which is more similar to that of the footnotes, and which will also include a good summary of the various accounting policies. So these are the different kinds of financial statements that need to be prepared as per the IFRS. And while preparing all these things, the general features that are being considered with respect to the preparation of these financial statements, a lot of them we have already discussed. They need to be fairly represented. Means they need to be complete. They should not contain any kind of material errors. All the transactions and events are represented in a faithful and a fair manner, following the relevant standards for representing them. Then another assumption that or another key feature is the assumption of a going concern basis. So any company that is preparing the financial statements will prepare it under the assumption that it will continue to exist at least for a reasonably foreseeable period of time. Then the financial statements are prepared completely on an accrual basis, not the cash basis, which means the revenues, the income and the expenses are typically recognized into the financial statements at the time where they occur or incur, not the timing of the cash receipt or the payment. Then there should be a lot of consistency in terms of the preparation of the financial statements. The financial statements need to be comparable with other firms or even across time. So so different kinds of companies, whatever the industry they are from, a particular event needs to be presented in a particular manner only. So there should be a consistency in terms of presentation, in terms of classification of the elements into the relevant accounts or under the relevant groups. All these things need to be more and more consistent. This is one more important feature of IFRS. Then we talk about the materiality. There should not be any material errors, omissions. No transaction can be omitted. No transaction or event can be misstated. And if the elements are more similar, if the various accounts are similar, they should be aggregated. And if they are completely dissimilar or different, they should be separated. So even that is a clarity that is brought about. No offsetting of the assets with the liabilities, or no offsetting of the income and the expenses unless there is any specific standard which allows for the same. Unless there is a standard which is clearly mentioned with respect to the offsetting, other entities cannot be offsetted in the financial statements. And it also talks about the frequency of reporting. It should be at least annual. Of course, it could be much more frequent as well, but mandatory is more annual. It should be comparable. So, which means the prior period's financial data also needs to be presented in the financial statement for a comparison purpose, unless there is any specific standard which restricts from presentation of the same. And another important thing that came out is with respect to the structure and content. It says the balance sheet should be more or less a classified one, which means there should be the assets and liabilities typically are treated as current assets and non-current assets. Liabilities should be classified as current liabilities and non-current. Anything that is about to receive benefits in the next 1 year, we say current. Beyond 1 year, non-current. Any obligations that need to be settled within the next 1 year, they become current liabilities. Beyond 1 year, they go as non-current. And it also says that the minimum information should be represented on the face of the financial statements. Again, it should not be so cluttered, representing again a big trial balance in the financial statement. A good decent aggregation of the accounts need to happen. A few or required elements only need to be presented in the financial statement. Anything which is not going to provide a reasonable understanding, or anything that is not going to give a reasonable decision making capability, should not feature on the face of the financial statements. So all these important features have gone into the development of IFRS framework for financial reporting. Right? Now I would like to look at the US GAAP versus IFRS. Okay, today there is a lot of consistency that is coming out between these two mechanisms, right? There are a lot of areas where both of them typically started converging on, because what we typically see is US GAAP is mostly prepared on a rules based kind of an approach, right? Almost all the standards are typically rules based, which means every transaction how it should be classified, it's giving a specific guidance on each of them. So it's a complete rules driven kind of an approach. Whereas on the other side, we see IFRS as mostly principles based kind of approach. When I say principles based, it's a broad framework. It does not go into the specifics of what needs to be followed for what transaction. It is more of a broad framework, guidelines based framework. It doesn't go into the specifics. Whereas a mixture of these two frameworks is primarily the objectives based framework. So wherein there is some amount of flexibility, it's not fully broad as the principles based, and it's not fully narrow as the rules based. So though there are a few set of rules that are existing, there is a provision in terms of flexibility as well, as long as specific objectives are being met. Now what we are seeing is the GAAP and the IFRS slowly are shedding their existing zones of frameworks and slowly moving towards this a middle approach, which is the objectives based kind of a framework, which is more or less a mixture of these two approaches. So what we could see is that's one important movement that we are seeing as a positive thing, and that is where the convergence is expected to happen. But still, even today, there are a few major differences that we see between the GAAP and the IFRS, especially with respect to the elements. As far as IFRS is concerned, especially with the income statement, it says only income and expense. These are the two elements relating to the income statement. Whereas the US GAAP still says revenues, expenses, gains, losses, and comprehensive income. These are the five major elements that go as a part of the income statement. So the classification is still different, the elements are still different, and the definition of the asset is different between the IFRS and the US GAAP framework, because US GAAP says an asset is a future economic benefit. Whatever the benefit that comes in the future, that is what is the value of the asset. Whereas from an IFRS perspective, it is not talking of a benefit, it is more talking in terms of a resource which can give you the future economic benefit. So the way the asset is defined in terms of both of them is different, and the major difference is the upward valuation. IFRS is allowing any asset to be valued on the higher side, which means if the value of the asset goes up over time, the modified value can be represented in the financial statements. Whereas what US GAAP says is, even if the value of the asset is typically going up, don't represent the modified value, represent the old value only. So the upside revaluations of the assets are completely not allowed as a part of US GAAP. That is one major area which is the difference between the US GAAP and the IFRS. Now, companies have the flexibility to prepare their financial statements under any of the frameworks. Sometimes some companies which are non-US based, they may prepare it in a different framework altogether. But whatever it is, there is a possibility of preparing a reconciliation statement, which will simply say if at all the financial statements have to be prepared as per a particular financial framework, particular reporting framework, what would have been the financial results? So that is something that goes as a part of reconciliation statement. To a large extent, it happens that all the companies that are in that are listed in US and are not following and have not presented their financial statements as per the US GAAP, they may have to reconcile their financial statements with respect to US GAAP. But at least those companies which are following IFRS, right now they don't need to reconcile their financial statements with respect to US GAAP. So from all these perspectives, it is becoming more and more evident and necessary that there needs to be a coherent reporting framework existing. Whether IFRS meets that kind of a coherence or it deviates is can be known only through time, but a coherent reporting framework is very much required, which provides lots and lots of transparency in terms of fairness of presentations of the financial statement, which is heavily comprehensive. Any new kinds of transactions that come up, any innovative financial products are going to come up, they are easily captured by the framework and new standards can be developed, and it should be more and more consistent across the period. It should be comparable across the geographies, comparable across the different companies, industries, different time period. So any reporting framework which can bring all these characteristics get classified as a coherent framework. But of course, what we see is the key areas where we see barriers with respect to this coherence. One is with respect to the valuation, how each particular element needs to be evaluated, which is more talking about the measurement basis. Some of them require to be measured on a historical cost, some of them require on a fair value basis, some of them may require on a current value basis, some of them on an amortized. How to bring in the consistency in with respect to the valuation of the various assets and liabilities. Then the standard setting bodies itself, should it be more rule based or should it be more prescription based or should it be a more principles based or should it be a blend of the two? So arriving at a coherence or arriving at a consistency on these lines is one more difficult factor. Then we are talking about the measurement mechanisms itself. On one side we say that the balance sheet, which is values at a point in time, whereas on the other side we talk about the income statement, which consists of values throughout the period. Now what kind of mechanisms need to be followed for valuing the elements here, for valuing the elements here? You will find lots and lots of inconsistencies across the various standard setting bodies or across the various regulatory bodies of different countries in terms of coming to a common understanding on the representation of all these. And on the top of this, there could be political pressures that can come out from those parties which are getting affected because of the change in these kind of reporting requirements, right? So those are the things that need to be overcome in case a better financial reporting framework which is more and more consistent across the world needs to emerge. And especially from an analyst perspective, if I have to look at the upcoming developments with respect to the various transactions or kind of changes that are coming up with respect to new standards that are coming up, any developments that are coming up. From an analyst perspective, there should be a monitoring how these new transactions. First of all, there should be an understanding of all the kinds of new innovations, new products, new transaction types that are going to come out in the industry, what kind of impact they have on the financial statements. All these things need to be quite comfortable for the analyst. And are they currently existing as a part of the existing financial reporting framework? Are not existing? There should be a clear understanding for the same. So a constant upgradation of the knowledge with respect to all these new aspects from various resources, from various websites, and the various disclosures of the financial information needs to be done by the analyst to make sure that appropriate adjustments are being made and the financial position and the financial health of the company is analyzed more and more properly. And any such kind of disclosures, we have seen that companies have to mandatorily provide them as a part of the footnotes, and some kind of detailed discussion should go about them with respect to the management discussion and analysis also, especially where heavy changes to the accounting policies are there. Any kind of judgments and the estimates which have a heavy influence, they all needs to be disclosed even as a part of MD&A as well. Now, from an analyst perspective, he can go through these things in detail to typically understand where all there were changes in the accounting policies. What are the significant accounting policies the company is typically following? What are the deviations or what are the changes with respect to the competition? All these things can be understood. And one more important disclosure that typically comes up is any new standard that comes up, the company really needs to evaluate that new standard, very clearly disclose what is going to be the impact of that new standard on the financial statement, what all changes are going to come up to the financial statement because of this new standard. Are they going to be impacted? Are they not going to be impacted? Or will they be taking some more time to understand the standard and make the necessary changes? If they have to make the necessary changes, there is some amount of uncertainty that is going to come up in the future in the financial statement. All these things need to be very carefully be analyzed by the analyst. So the more and more comprehensive the reporting framework is, the more it will be helpful for the analyst to assess the performance and thus the financial health of the company. So these are some of the important aspects that we need to be comfortable with. So from a financial reporting standards perspective, understand why financial reporting is required, who sets the standards, who implements the standards, what is the kind of difference right now existing across the various countries with respect to standards? What are the various moves that are typically occurring with respect to convergence to the financial convergence to a common framework? And then talking about specifically to IFRS, what is the framework that IASB has come out with the development with respect to the development of the IFRS framework, the different qualitative characteristics, what elements need to be reported, what is the measurement base, how should some items be recognized in the financial statement, what are the various constraints to the financial statements, and what are the various assumptions that go into the preparation of the financial statements. Then we are talking specific to IFRS. What are the various financial statements that need to be prepared? What are the key features that are associated with the preparation of the financial statements? In what areas the IFRS is differing from GAAP at this particular moment? What are the key elements that go as a part of a coherent reporting framework, and what are the barriers right now to achieve the coherence in the reporting mechanism? And typically we ended up this particular session with in case new standards are going to come up, how should an analyst understand those new transactions, new products? How should he evaluate the impact on the financial statements? How can he typically use the disclosures of various companies, footnotes and management discussion analysis to typically understand the change in the accounting standards, or the impact of the new standards on the financial statement, and how he can use this entire framework to evaluate the financial health of the company more effectively. All right.